All right, let's get started. So here we're building a portfolio from zero. So when getting into a big project like this, you want to start with a full thesis. So this should cover our bases for now. We'll be starting with this living duck and update it as we go along and develop and grow in this channel. You always want to start with an investment thesis and a master plan. So here it is. An investment thesis is your guiding philosophy. This is going to answer all your questions whenever you have some kind of impasse. This is what you're going to come back to make your decisions. So first, our guiding philosophy is to keep things simple. We are only going to buy assets that are easy to understand. I am only buying companies with very simple business models and pretty simple investment strategies. I'd also like to focus on companies that focus on hard assets. So what that means is their business model focuses on physical, tangible materials rather than financial instruments like derivatives and things like that. We won't talk about that right now, but just hard assets, things like cars, things you can touch and move. Kaizen is a guiding principle of a strategy of continuous improvement. So nothing too aggressive, nothing too crazy. We'll accumulate marginal gains, dollar cost average into positions. What that means is rather than putting a giant bunch of money into a company all at once, we'll average that position and grow it over time by buying a small amount of shares over a long period of time. And finally, our mindset and lifestyle. Mindset with investing is really important. You don't want to be overly emotional. You don't want to panic sell, panic buy, things like that. But we also don't want to be too timid and miss out on opportunities. So we're going to be bold, not be afraid to take risks when opportunities present themselves. And we'll also be doing weekly videos with updates on what I'm buying, my due diligence, and growing the portfolio. So moving on to the meat and potatoes, our investment strategy. There we go. So this is answering the question, how are we going to grow the portfolio? So first, we're going to find a trusted brand and buy its suite of broad market ETFs. So rather than focusing on individual companies, we're going to find stocks we can buy that are a basket of companies, things like index funds, mutual funds, things like that. I'm going to focus mainly on ETFs. These are called exchange traded funds. And as we grow, we can go into a deep dive on what an ETF actually is, but there's plenty of videos out there that are really good. And maybe we can watch those. I'm going to look for one that is fairly new and that owns a logical basket of assets. No ETFs that are just, going off the rails, buying some crazy stuff. I'll be keeping the majority of the value in these safer assets, in these broad market ETFs, and then build smaller positions in individual stocks that are higher risk, higher reward. You don't want to put everything in low risk, low reward assets. You want to have a nice little mix, but not get crazy. The majority will be in these safer broad market ETFs. Was that everything there? Oh, the other part of this strategy is to generate some cash flow. So what we'll be doing is holding shares of companies like REITs, MLPs, normal old dividends, and cash interest. This is how we will be generating cash flow. So REITs are real estate investment trusts. These are companies that own real estate. They collect their rent, collect their fees or whatever they're collecting, and then pass that on to you as the shareholder in cold hard cash. MLPs do the same thing. These are master limited partnership. These are things like pipelines, oil pipelines, electrical lines, utility companies, and they're going to charge a toll to use their infrastructure, and then they pay those tolls out to their shareholders. Normal old dividends. Again, these are dividends come from very large companies that can't grow as quickly. So as they make their profits and they make their money, they then pay that as cash into the account, and then just regular old interest, holding cash in an account, earning interest on it. So we'll generate some cash flow as well as growing the portfolio from ETFs. That's my general strategy. This is a pretty run-of-the-mill, standard textbook strategy. Now, also part of your master investment plan is your risk tolerance. This is highly individualized. Everyone has a different, sort of level of risk they can tolerate. So you want to answer the question of how risky do you really want to get? So for me, very low to medium. Most of the value, like I already explained, will be kept in a safe-ish broad market ETF, but also it's okay to fuck around and find out a little bit. And when the opportunities present themselves, if those opportunities come up, we'll be doing our due diligence. We'll be doing a deep dive, going into the numbers, companies' strategies, their risk management, and before we dive in. Next, you want to figure out your brokerage. Now, there's a ton of brokerages to choose from. And you want to find out what brokerage are you going to use and why. This is your account, and this is going to be where all your stocks are held. You can think of this like a wallet or like your main accounts. I'm going with Robinhood, and here's why. In particular, there's no fees. Some brokerages will charge you per transaction. Robinhood does not. They also offer fractional shares. So what that means is if a stock is extremely expensive, maybe it's $500 a share, and you don't really have that much with Robinhood, you can put something on it, drop a little, $25, $30, whatever you have, and still buy some of these very expensive companies and keep them in your profile and still get those gains. Robinhood also offers a different set of assets options. You can buy stocks, you can buy bonds, they trade options. I'm not going there quite yet, but maybe eventually we'll grow into it. They also have a phone app, so you can check it when you're on the go, you get a little bored, or you need to emergency dump, you want to emergency buy, something like that. Robinhood does all of that for us. But in particular, their fractional shares are pretty good. Also, this comes to mind, they're paying 5% interest on cash holdings. So when you're starting a portfolio and you're not really sure what you want to buy, you're not really sure what strategy you want to go with yet, you can just load your cash in there, let it sit, and earn 5%. They also pay out monthly, which is pretty great. This generates cash flow right off the bat. Sorry, I'm going a little faster. I'm trying to get this done in one take. So next is asset selection. These are how you're going to select what you're going to buy. So we're going to ask, what are we going to hold in this portfolio? So pretty simple. Already explained ETFs. These are exchange traded funds. This is just a basket of stock. Some of them are actively managed. And rather than buying individual companies, it's just going to be a basket of stock that gives you instant diversification. You can just buy that, hold it. You don't have to do too much worrying about that. We're also going to buy some individual stock, some crypto, and we'll consider bonds. I don't think you can buy bonds directly through Robinhood. I might have to do that through a different brokerage. But right now, mainly focusing on ETFs, individual stock, and crypto, at least for this series. And of course, we're just going to keep cash in the account. Any extra cash, any big dividend payments, it's going to hang out in the account and still earn us interest. It's not just sitting there doing absolutely nothing for us. Next is fundamental analysis. So this is how we're going to track performance. And we're going to do this with KPIs. Whoa. So when we're tracking performance, how we're going to track this is through measuring trends. We'll be measuring trends in efficiency. So that's how well a company is run, how much each dollar is doing work. So you're measuring your bang for your buck. For every dollar you put in, what are you actually getting out of that? And we'll also measure KPIs. This means key performance indicators. So these are going to be things like efficiency, PE ratios, things like that. We'll get into that in a minute. But KPI just means a key performance indicator. How well are these companies performing? And the way we're going to track that is by looking at the trends of these indicators. And it'll make sense later. For this performance, we want to find companies that have an upward trend in these KPIs. Is their debt trending down? Is their revenue trending up? Are their ratios trending up? Is revenue trending up? We're going to look at things like that. But also, going with our thesis, keep it super simple. No major complicated charts, nothing that you need a PhD to understand. And then we also want companies that can sustain these trends. So we'll be looking at acquisitions, mergers, and the company's just general strategy. And can they maintain these upward trends? Some of the indicators we are going to look at. Can I actually put that under A? Nice, nice. No, maybe? Ah, there we go. Nah, it doesn't work. I'll mess with that later. So some of the KPIs we're going to look at are efficiency. So we'll be looking at the profit and loss sheet. This will give us most of our ratios on how to tell if a company is operating efficiently. We'll also be looking at PE ratios. That's kind of standard. That's the price to earnings ratio. This will tell you if the company's overvalued, undervalued, and we'll get into it later. These KPIs and your efficiency can be specific to an industry. A high PE ratio in one industry might be low in another. This is very, very specific. But generally, a ratio of 10 to 30 is like your usual tolerant zone of where you want to be for your PE ratio. We'll also be looking at some hard numbers and ratios, specifically PE, margins, debt levels, and the stuff on the balance sheet. We'll want to see things trending upwards on the balance sheet. Not going to go too deep into that right now, but as we move forward in this channel, that's what we'll be looking at. And now we want to set some goals. So this is what are the goals we're going to hit. So in the short term, we're going to establish a core set of core holdings, start generating some cash flow. In the should mess with these headings a little bit. In the medium term, we're going to slowly grow our core positions in the holdings, and 100 a month I think is it's ambitious, but we can still get there. At $100 a month of cash flow as our medium-term goal. And in addition to the short-term goals where we're establishing the core set of holdings, in the medium terms, we want to add some wildcard companies. Just some small positions in some wildcard companies that if they jump 70%, 60%, we don't lose out on those gains, but keep the position small enough that if we lose it all, it's not the end of the world, and our portfolio will continue to grow. And then, of course, in the long term, $1 million. This is our long-term goal. I think this is what everyone wants to get to, and maybe generate enough cash flow to start covering some rent, covering some bills. But in the leading up to that, we're going to be reinvesting all of our dividends and all of our gains to keep the portfolio going, unless there's some kind of emergency and I need it immediately. That should cover the fundamentals, other than some little organizational and formatting issues on my documents here. I'll be doing this mainly in OneNote. Might move over to Obsidian, and so you might see the screen change. But that should cover all of our bases for our full investment thesis. And it should cover our first intro video for the channel. Stick with me as we grow and learn. The next video, we'll be moving into the actual portfolio, what that looks like, maybe how to navigate through Robinhood and go from there. But, let's do it. Thanks for coming. See you next time.